you've got to get the neighborhood right.
Yeah.
If you don't get the neighborhood, it doesn't matter what you do because it's hard to get good people to pay up and live in bad neighborhoods. It
Mm.
doesn't. You could build an empire there. It won't matter because they won't come. So the
Gotcha.
location thing, the neighborhood, it is number one on our list because I've
Okay.
learned this lesson over 30 years. You can't change the neighborhood. You have to
Yeah.
buy the whole neighborhood, and it's still hard because it has that reputation.
Welcome, my fellow Flowmasters, to another episode of the Cash Flow Authority podcast. I'm your host, Chris Jansen, founder of the Flow Authority, and this show is for high-performing professionals who did everything right. You've got the degree, the career, the income, but you just feel like there's another level waiting. So here we explore how real estate can be that next challenge worth building so that you can take ownership of your future and create a life by design. And today we're joined by a very special guest, fellow 10Xer, Mr. Ken Gee. And Ken is the founder of and managing partner of KRI Partners. He is also a real estate private equity firm specializing in the acquisition and management of value add multifamily assets worth about $160 million. So lots of great things we're going to talk about today. But Ken, welcome to the show. Glad to have you, man.
Thanks for having me so much.
You bet. You bet. So I always like to go back to the journey. What have you been through and how did you kind of get to where you're at today with multifamily real estate and KRI Partners?
Yeah, so I'll tell you the story, be brief. Grew up in Toledo, Ohio, got my undergrad from the University of Toledo. I'm going to sound like a lot like your listeners, what you just described. I moved to Cleveland, became a commercial lender while I went to school at night at Case Western Reserve University for my graduate degree. That prepared me to be a CPA, and I went to work for Deloitte for about 7 years on the tax side. So I did a lot of M&A work, tons of work with private equity firms, a lot of due diligence, tax planning, all that really fun stuff, right?
Mm.
It was there, though, that something happened to me. So you need to rewind the clock. Like it's almost been 30 years now. My daughter was an infant. I used to do her 3 a.m. feeding every night. You know, I was working at Deloitte a lot. You work a lot when you're a CPA. And so every 3 a.m., middle of the night feeding, mom needed sleep. It would be her and I. And it was really cool time because we got to bond, right? If you're a parent, you know exactly what I mean. You can't beat that time. Until I realized, now this is where it connects, like literally you just told my story. I thought I did everything right. I went to school. I got good grades. I had a great job. I was supposed to be living large. And then I realized it's 3 o'clock in the morning, and this is the best I could do for my family and my daughter. I thought, man, I didn't think this through quite right. This isn't good. And so I knew that I didn't want my family to grow up without me. And so I said, you know what? What I didn't tell you is 5 years at the bank, all my customers were in real estate doing very well.
Mm.
My time at Deloitte, we had the Cleveland office had the biggest real estate tax practice in the firm. So I got to see clients that were worth hundreds of millions of dollars, all in real estate. And I thought, man, I got to figure this out. So I spent 18 months trying to figure out the business. I did figure out the business, bought 3 small deals, a 28, 24, and a 22 unit deal. Sold them 3 years later, made $500,000 and realized, wow, I just did it.
Nice.
So I stuck around at Deloitte for another year and a half because I'm a really careful guy. And then I left Deloitte, and this is all I've done since. I will tell you, mission accomplished. I never missed my kids' sporting events, school plays, none of that stuff because I was able to be in charge of my time.
Yeah. Wow, that's incredible. I love that. I love your story. And it's very empowering and encouraging to others who, even to me, did quit my job as well to focus on multiple things. One of which is real estate, coaching, a few other things as well. But yeah, that's awesome. That's really encouraging. And fortunately for me, unfortunate, I don't know. I don't have kids yet. I do want kids at some point, but I'm trying to do this in the right order. I guess I would say I'm fortunate because I've learned from others before having kids that, hey, if you want that time, here's a way that you can do it. So you're case in point, and it's usually not that pretty. Even in my case, it's not pretty at all. I'm going to be honest. It's messy as all heck, but you got to give it a shot. You got to go for it. And so I love your success story. That's awesome. And a fellow Midwesterner too.
That's right. Yes. Yes.
Yeah.
You'll get there. You'll get
Yeah,
there. You'll plug
thank
away
you.
and you'll get there.
Thank you. So you said small, 28, 24. Were those small to you at the time, though, as your first
Yeah.
deals?
No, they felt big. They felt massive.
Yeah.
I'll tell you why I started there. Most people start off with singles, doubles, and all that.
Yeah.
Problem is, I couldn't figure out how to make money on that. It just didn't. I just couldn't figure it out. A lot of people do. I couldn't figure it out.
Yeah.
And then there's this problem that I was working 80 hours a week, and I knew
Yeah.
that I needed to have something that was big enough to be a business, right? Had to be a business so that I could hire someone to help me out to do all the stuff on site. I couldn't do it. I was already way extended with my family and
Yeah.
my time at Deloitte. So that's what led me to 28 units as my first deal.
Gotcha. Gotcha. And did you have to raise money for that, or did you just have the
No.
money ready to go? Okay.
Oh no, I didn't have the money.
Okay.
No. I always tell people when you start off sitting in my chair, most people in the
Yeah.
beginning, they have nothing. They have no money. That's why they're
Mm-hmm.
doing it. So I borrowed my half of the down payment on my home equity line, got my in-laws at the time to be my partners,
Mm-hmm.
and we did it together.
Okay. Awesome. Awesome. Through partnerships. Good. Yeah. So that's
Yeah.
something, again, that I've learned and that I like to talk about because, especially, I come from an engineering background. So a lot of us science, tech, engineering, math type people, we like to be lone wolves and just, I don't want to talk to anybody. I don't want to team with anybody, partner. I just want to do it myself. But
Yep, it would be me. Yep.
yeah, but real estate's a team sport for sure, and I'm slowly getting into those partnership roles. But the more I meet people like you, the more I see that's where you got to be.
You have to.
You got to, right? You got to. That's how you scale if you want to actually build something meaningful from it.
That's right. Yeah, your partner is going to fill the gap that you don't have. And
Yeah.
back then it was some money. I didn't have any.
Yeah, exactly, exactly. Awesome. So I want to get to the question about value add.
Yeah.
In the bio, you do value add multifamily. So
Yeah.
I guess what does that mean, and what do you really look for? What's a strong value add opportunity that you kind of seek out?
Yes, we are the life cycle of typical real estate investors starts off with lower quality, heavy value add, meaning you got to really do a lot of improvements and you're selling quickly, right? You're in making money mode. That's what I call it, right? And it's heavy value add, like you go in, you blowing out kitchens, doing all that kind of stuff. What happens after you've turned a whole bunch of unit deals and made money? You find yourself, now you're on a treadmill and you're like, wait a minute, I want to actually create long-term wealth. I don't need that next dollar in order to feed my family. Now I want to create long-term wealth. And so what typically happens, and not everybody does this, but you migrate it, you evolve into higher quality assets. And that's important. So, but here's the catch. Even though you're in higher quality assets, you still got to add value to the world. That's how businesses become successful, by adding value in some way, shape, or form. So even though the last 2 or 3 deals we bought were much newer, like 24 build, 25 build, that kind of stuff, there's still value to be added. And that's the key, right? So some people always think, you just bought a brand new deal. There's no value to add here, and they would be wrong. Because that's how you make money in this business. It's how you make money in any business. Is find a way to add value. So yeah, we're value add investors. It just so happens to now we add value differently than we did in the beginning.
So like on these newer deals, what are some, instead of blowing out the kitchen, what are some things that you would do maybe on the last deal you did, for example?
Yeah, so it's going to be different for every property. On the second to last deal, we did some amenity improvements because the builder just, you can tell when builders start to run out of money because they don't quite finish, right? And it needed to be finished. So we did some of that. And so what happens when builders fill their buildings is they give away a lot of free rent. They don't care about giving away. They just need heads and beds, right? That's what we call it. And so heavy discounting. When those leases turn, there comes the management side, right? You're going to serve that client, their resident well, and then you're going to be able to slowly raise rents. On that deal, it was a combination of physical and management improvements. On the last deal we did, it was built by a very high-end builder. He builds 5-star hotels all over the world, and he just went nuts on this place. It was gorgeous. It's beautiful, well built. There's not much I can do on the physical side, but here again, it's a builder, and now we're adding value through really operating it like it should be run.
Okay, so more on the management side.
Value add is defined differently depending on what kind of property you're buying.
Yeah, for sure. Yeah, and engineering, what you mentioned about skimping out on some amenities, right? Now, I didn't engineer multifamily, but it's the same nonetheless. Engineering, construction, what we call, now that I'm saying it out loud, I'm blanking on the word, value engineering. There you go. We call it value
Okay, yeah,
engineering.
yeah.
So, hey, we're running over budget a little bit. We got to do some value engineering, which is basically let's sharpen our pencils and
Yeah.
remove some fun things. Let's reduce the quality here. Maybe we don't need stainless steel or 316 stainless steel. We can do this other type, those types of things.
That's exactly what happens. Yep.
But
100%.
exactly, yeah. Okay, awesome, awesome. And for those who follow Grant Cardone, so Grant Cardone will say, "Oh, just skip to the good stuff." He'll say, "Don't do the value, or not, don't do the value add, but because that's like you said, defined differently. But don't start out with the C-class property. Skip to the good stuff. Just go straight to the A's and the best neighborhoods." I guess. What are your thoughts on that? I'm not trying to get you to argue with Grant when he's not here to argue back, but just kind of
Yeah,
curious
no,
on
we
that.
banter back and forth all the time. So
Yeah.
here's the thing. If you're brand new and you're not at a Grant Cardone level, they don't build a whole lot of brand new properties that are 20, 30, 40 units. They just don't. So it's hard to do that. Now, what
Yeah.
he's not wrong on, I'm not saying he's wrong on anything, but
Yeah.
you've got to get the neighborhood right.
Yeah.
If you don't get the neighborhood right, it doesn't matter what you do because it's hard to get good people to pay up and live in bad neighborhoods. It doesn't. You could build an empire there. It won't matter because they won't come. So the location thing, the neighborhood, it is number one on our list because I've learned this lesson over 30 years. You can't change the neighborhood. You have to buy the whole neighborhood, and it's still hard because it has that reputation. 100% agree on that. On the size, look, with all due respect, you're probably not going to buy an $80 million deal for your first deal. It's just not going to happen. They're not going to give it to you. It's never going to happen unless you're Bill Gates or somebody, then they might, right? Which most people are not. So most people are, there's nothing wrong with starting off with C class, B class properties, nothing at all. I do want you to not negotiate your neighborhood though, because you'll be sorry.
Yeah.
I promise you'll be sorry if you do.
Okay. That's good. That's good. So it's more than just cash flow. Because you look at a neighborhood that's not so good, right? And I get so many mixed opinions on this, so I'm glad we're having this conversation. But
Yeah.
you look at a neighborhood that's not so good and a property that's also not so good, but it's like, oh, the numbers though, they're so juicy, right? The numbers are so good from a cash flow perspective. So it's not all you want to be factual and objective and look at your numbers, but that can't be your only criteria. You've got to have other things in place to protect you, like certain neighborhoods, right?
Yeah. So remember, when you start out, you're trying to add value to your property.
Yeah.
How do you add value? There's only one way: to make it nicer, so that someone will be willing to pay more to live there. That's how you add value. It's no other way, and especially with those types of properties. So you don't want to be in a neighborhood where if you improve, you're going to be the only house in the neighborhood that's beautiful.
Yeah.
That doesn't work. It just doesn't. I just want you to keep that in mind as you're looking at the deals. Starts with neighborhood, then cash flow is important. But you want to know where the real money's made in multifamily? It's not the cash flow, right? Everybody thinks, "Ooh, I'm going to get this 5% or 6%." That doesn't change your life. What changes your life is when, and now think about this, if you added $100,000 of NOI to the property because you raised rents, right? It's not the 100 grand in new cash flow distribution that makes your life change. What makes your life change is the change in value. In the multifamily space, if a 5 cap is generally a 20x on your money. So if you move NOI by 100 grand, there's a pretty good chance you just move value by 2 million.
Yeah. Yeah.
That's where the money is. It's in the appreciation.
Mind blowing.
Yeah. So those high cash flow deals, they generally are high cash flow because there's not much room for appreciation. Because you can't raise rents much if nobody in the neighborhood can afford to live there, right? Because of their income. You see what I mean? So you got to watch that. It's a cash flow appreciation balancing act that you need to go through. And cash flow is important, but what's most important is that you're able to add to cash flow so that somebody will pay you more when you're ready to sell it than you paid for it.
Yeah. Makes sense. Yeah. And I get that, but the listeners maybe not. This is something that you got to hear multiple times probably multiple different ways for it to really make sense. Or just for numbers, guys, run the numbers. Just run the numbers. Hey, you increase the rent by this much times by the number of units, right? And that's your add to the NOI and divide by the cap rate. Boom. There you go. There's your value add. So,
20x is a good multiple on mine, at least.
Yeah.
I think so.
I think so too. I think that's excellent. So
it's why we're here.
Awesome. For newer investors analyzing deals, what are some of the biggest mistakes that they make when analyzing the deal and just evaluating opportunities in general?
Yeah, probably the number one mistake new people make is not recognizing a neighborhood for what it is. Because it's not scientific. It's more of an art. You got to look for little subtle signs. So that's the first thing that people do wrong. On the numbers side, the number one mistake they make is they don't see. Now, I'm a CPA by background, and I believe in bottom-up underwriting. That means this is a business. You're about to buy a business. You're about to ask a whole bunch of people to give you a whole bunch of money to invest with you. I think it is only fair that you understand the business from the ground up, right? You know how much payroll is going to be. You know how much real estate tax is going to be. You know how much pest control is going to be. Every one of these numbers, you can figure them out. Yeah. You just have to take the time to do it from the ground up. I always tell people, I want you to imagine yourself on Shark Tank. Everybody watches Shark Tank. And I want you to stand there in front of Mr. Wonderful and let him figure out that you really don't know the detailed numbers in your business. And I want you to imagine what's going to happen to you. It's not going to go well. You and I know that, right? So that's the number one mistake. A lot of people, guys have been doing this a long time, and I know how they get there. Grant can do this at a high level. I can do this at a high level without diving, because we've underwritten so many deals. We just know what it's going to look like. And so they think they can do the same. And then what happens is, if you ask me a detail about underwriting that we do, I just know the answer. I know why, because I've been doing it for almost 30 years. Guys like Grant, they know the why because they've been doing it forever. You're brand new. Your why can't be because that's what I think it'll be, right? It's got to be based on some real data, because otherwise people will sense that you're new to the business. And that's the mistake they make, is they don't realize that now investors want you to know why. They want to know that you understand the business that you're investing in. And that's the mistake they make. And then they don't figure it out until they try to raise money. And it's hard to raise money. And personally, I think it's ridiculous to ask somebody to invest in a business unless you really know it, right? I just don't think it's right. You shouldn't do it. So that's the number one mistake. Learn the numbers and learn them at a detailed level. Then you can go up to 30,000 feet, but you got to start at the bottom first.
I like to I have my own properties, so I do look at past experience to help with that, but I also run things I have property managers that I work with, so I run it by them. Hey, this is what I'm getting. Where are you seeing rents, and what are you seeing for rent growth, and those types of things. So how important is it, in your opinion, to have a good, whether it's actually somebody you hire or a partner of yours or just a firm, a company, a property management company, that you can bounce ideas off of it like that?
Yeah, so if you're brand new, we manage our own stuff. We're vertically integrated, so we've been doing this almost 30 years, so we know. If you're new, nothing wrong with having a third-party manager there to run that by, right? And if that's part of your business plan, that's great. I just want you to be careful, because remember, when you buy that property, that means the third-party manager now has a new client and has more revenue.
Yeah.
And I want you to be careful that you're not getting advice from someone who's biased.
Gotcha.
Right? You just make sure that they're being honest, right? If they poo-poo your deal, they're not going to get a client. I'm not saying that they would really do that, but the risk is there.
Yeah. And I've had terrible experience with my first property management company. So don't just, they're professional, they have an LLC, I can trust them. Or even if they were actually, the first one I worked with was a referral. So I'm like, I thought I could really trust her. And when I say her, because it was really a one-woman show, it was a very small operation. And that came back to bite me. So to your point, right? So it's your investment. You got to protect yourself. You got other investors even more so now. And definitely, but these people I've been working with I've already worked with on multiple deals, but that's a good point. I got to remember, I got to keep that bias in
Well,
mind.
the longer you have that relationship with them, the better off you are. You just
Yeah,
know. You
for
can
sure.
tell. Yeah, they deliver. They're always honest. They always tell me they can
Yeah,
do A, B, C, and they do it. That's awesome. That's
for
perfect.
sure. For sure. So now switching gears to, okay, you get your first property. Now you want to really scale a portfolio. So what does it take to grow from small investments into the multifamily assets? I think we kind of touched on this a little bit, but maybe just kind of close the loop on that
You
question
mean
there.
like a single family, 1 to 4 family investor?
Yeah, or even from
Yeah.
you started with like the 22, 24
Uh-huh.
units, and now I don't know what you're buying now, but it sounds like it's a lot bigger than that.
It is, yeah. They're a lot bigger now. So there's a couple of things. One, if you're really going from 1 to 4 families into multifamily,
Uh-huh.
they're underwrite very differently, and you got to know how to underwrite a multifamily
Mm,
deal. And I think you already know that, but that's really important.
mm,
In terms of if you want to build a business, you need to think of this as building a business. You need to build in systems and processes and
mm.
checklists and all that kind of stuff so that you can do this so that every single time you do it, you're not reinventing the wheel, number one. Number two, you have a system process that you can teach others so you can duplicate yourself. All these things, it's a business. And everything you're going to do in a business,
Mm-hmm.
HR, maintenance, insurance, everything you have in a regular business is there in apartments. You just need to build the scale and the foundation so that as you grow, it all happens the right way. Like we don't do third party management. We manage our own stuff. So a lot of our growth was about making sure that we knew which KPIs to monitor and our system monitors them and all you build all that stuff into your system.
Okay.
But if you're using third party management, now you got to build in a system to manage the third party manager.
Yes,
Because
absolutely. Yeah.
that, in my opinion, now there's no way I would go to third party. No
Yeah.
way. I've been doing this so long, they would drive me nuts because they wouldn't pay attention to it like I do. You know what's
Yeah.
funny about multifamily? Name another business where you can buy the business and offload all the operations to somebody else.
Yeah. Man, I
Good
don't
luck.
know.
I don't know of any. Right? It's a rather unique thing here. So just
For
be
sure.
prepared. You got to really micromanage them to make sure you're getting to your goals.
For sure. Yeah. Which I know Grant said this at the last one that I went to, the last real estate summit I went to. He said something that finally clicked with me. It's like, hey, I never understood that. He said before, oh, you buy a duplex, you're not gonna be able to afford a manager. I don't really get that because I buy a
Right.
duplex and I can pay for a manager just fine. But he reframed it to say, look, if you have a manager, or at least this is how I have it in my mind, right? If you have a manager and you have 2 units and they're managing 2 units for you, but then they're managing 500 units for other investors, and something goes wrong with, so they got a 100 unit property, who are they going to pay more attention to? Your 2 units that's paying
Yeah.
them $100, $200 a month, or the 100 units, right? So
Right.
that's actually keeping the lights on and giving them a
Right.
lifestyle that they want. So that really clicked for me, and I'm like, wow. And there's economies of scale because of that too, right? You can get lower management fees if you are using a third party. And if you get to
Yeah.
a certain number, then yeah, maybe you can consider doing what you're doing and really going the business route. And do you have employees then that you actually
Oh
hire,
yeah.
or
Oh yeah. We
it's,
got about
yeah?
45 employees. Oh yeah.
Wow. Okay.
Yeah.
Awesome. And how many units you guys got under management now?
Under management, we're probably 12 or 13. I don't know. I stopped counting a long time ago. Maybe 1,300.
Okay.
I'm, yeah, I don't know exactly what it is. Yeah,
Nice.
we're well over 200 million in assets.
Nice. That's amazing. It's amazing. Congrats.
It keeps us busy. No,
Yeah.
no worries.
Yeah. So I know you have the Multifamily Investment Academy, so you also help educate people on multifamily
We do.
investments. So what inspired you to create that, and what are
Yeah.
some of the skills that you really
Yeah,
help
that's a
investors to
loaded.
grow? Yeah,
Yeah,
I'm
that's a
sure it is.
loaded question. So 10 years ago, I had never intended to get into the education side of the business. Never. And about 5 years ago, back when everybody was going nuts around 2020, 2021, they were going nuts. And
Hmm.
everybody was like, oh my gosh, you got to get into real estate. We'd already been doing it for a long time. And I watched what people were doing. A couple of things happened. One, they were buying deals. They had no idea what they were doing. Two, they were inviting all these people into the deals, and they still didn't know what they were doing. And if you've been doing it for more than 25 years like I had at the time, I was like, man, this isn't going to end well. I can see what these guys are doing. They're paying way too much. They're not protecting themselves. They're not really doing their homework, right? And you can see this when you're on the sidelines. It's like watching a football game. You're like, he's an idiot. What's he doing? The same way. And it is what it is. And then I realized, wait a minute, all these guys that bought one, maybe two deals, they were now super experts. And they were happy to charge you 50 grand to learn what they know.
Yeah.
That they learned in 6 months. I was like, you know what? This is getting out of control. Two reasons I got into education. Number one, I couldn't stand by and watch people rip people off because it was happening left and right, number one. And number two, I knew that it was going to come home to roost. And you're talking to a CPA who lived through Enron. We weren't part of Enron, but the government will respond if enough people lose money. Guess what? I was terribly concerned that all these people were going to do ridiculous things because they were doing them, and they were going to lose a bunch of money, and the SEC was going to potentially act and start to put the kibosh on it. I said, you know what, Ken? You can stand by and watch this happen, and woe is me, things didn't go well, or you can go in and you can educate these people. That's the honest truth about why I got into education, because I say, I've got to teach these people the right way to do this business. We started with underwriting, then we teach the entire cycle, the whole entire, not just underwriting, but we call it our AMA program. It teaches you everything from concept to close. And then we have an entire owner's course. No one teaches anybody how to run a property. And so we have an entire owner's course. So we take you through the whole cycle.
Yeah.
So now I feel, and we don't charge them remotely close to what other people charge. Yeah. But what happens now is I get people learn the real business so that they can really be successful. Yeah. So that's how and why I get into it. I am proud to report that it's going well. People, they absolutely want to know the real deal. They want to know the details. They know they don't know the details, and it actually scares them. In many cases, they stop. They push and then they stop because they get scared because they know there's so many things that they don't know. Yeah. So that's why we're here doing the education side.
So what's the balance then between they learn stuff, but the more you learn, the more you realize you don't know, and that there's so much more you can know, but you can't wait till you know everything to actually start taking action. So I guess, how do you know? Where's that line, right?
So that's why we have something called an accelerator program. Not much. It's like a couple $100. But what it does is we see people, now they get stuck in learning mode. It's safe, it's easy, right? And they just keep learning and learning. And I'm like, guys, you got to get moving. So the accelerator does exactly that. We literally put them in front of brokers, show them how to find the deals, and really hold their feet to the fire. Let's go look at deals. Let's bring them, and it works. So you got to learn while you're doing. That's the important part. You're never going to know everything. Just like kids. You said you don't have kids yet, right? There's never going to be a good time in your life to have kids. Yeah. But you're going to do it, maybe, right? You'll just at some point, if you want to have kids, you'll say, I need to just go do this because I'm getting too old, right? Yeah. No, I don't think anybody raises their hand and say, okay, I've got everything ready to go now. Let's have kids. That just doesn't happen that way. Yeah. It's no different in business.
I need a girl first. Yeah, so this is going out to the world. Any beautiful women out there?
There you go.
Looking for a family.
Good-looking guy. You're a good-looking guy. I'm sure you'll get plenty of offers.
Awesome. Okay, so we're kind of nearing the end here. I want to kind of wrap things up with this. Looking to the future, what excites you most about multifamily, the future of multifamily investing, and maybe touch on what are you seeing in the markets? Are there more opportunities coming, less? What are you kind of seeing out there?
Yeah, I have been around for a long time, including 08 and 09, lived through all that, never lost a dime of investor money. I'm proud of that. Things are not as bad as they were, but this is, in my opinion, an insanely good buying opportunity. We have interest rates high. We got sellers who have to sell. They didn't perform on their pro formas, right? They didn't. They're not hitting their numbers. Their bridge debt is due. They gotta do something, and they have a choice. They can do a cash-in refinance, which their investors just say no, I'm not giving you any more money, or they can sell the property and get out of it as best they can. There's just so much of that everywhere. That's why we're a buyer. We got builders that have built stuff and they want to exit property. So I couldn't be more excited about this market. We are trying to buy everything we can find. We've now matured to the point where we raise the money first and then go find the deal. So we have, this time, I've got 10 million sitting in the bank waiting for a deal. And when you're that strong of a buyer, you get good deals. So I'm extremely optimistic for real estate. I think I'm not much of a market timer, but man, this sure feels like a good time to buy.
Yeah. Awesome. Hey, appreciate that context. And is that in one specific market or is that kind of general that you're seeing?
Every market is a little bit different, but that's a pretty good general statement. Building is down 70% throughout the state of Florida, 50% across the United States. Interest rates now, they were pretty good. People were getting excited, and then we had a war, which destroyed interest rates again because of the price of oil and all that. Hey, this just makes us put sellers in a worse spot, right?
Yeah.
It sucks if you're a seller, but if you need to sell, we're here, and we can help you get out of that.
Yeah. Awesome. All right. Thanks, Ken. Hey, before we wrap, where can people find and connect with you?
Yeah, two ways. Easiest way, KRIPartners.com, KRIPartners.com, and then you'll see our business kind of divided in half. Or you can just call or text 216-290-1707, and somebody from our team will jump on a call with you and try to figure out what you're really trying to do, right? Our job's not to sell you something. Our job's to help you figure out what's next. We've helped hundreds and hundreds of people figure this out, and that's the goal. However, whatever your life situation is, we want to help you take that into account to see the light. Because I've learned a long time ago, if it's you, it's hard to figure out what's next. But it's much, much easier to see the world the way it really is when you're outside looking in. And sometimes that call, that advice really helps.
Definitely. Awesome. Appreciate it, Ken. Lots of good conversations. I say this sometimes, but I'm being honest. There's so much we could dive deeper on a lot of these questions. We're both coaches. You're deep in the multifamily side, and there's just so much to learn. So I really do appreciate your time. I have to have you on again sometime. And look forward to seeing you too on the real estate club calls. So
yeah, absolutely. Looking forward to it. Thank you so much for having me. I really appreciate it.
Thank you, Ken. Thanks for tuning in to this episode of the Cash Flow Authority podcast. We hope the insights shared today help you take the next step toward optimizing your finances and building sustainable wealth. If you enjoyed this conversation, please take a moment to subscribe on your favorite podcast platform and leave us a review. It helps other entrepreneurs and investors discover the show. And don't forget to catch the next episode for more insights. Until then, keep mastering your cash flow.